Good morning, everyone. Welcome to Flyer's Real Estate, Direct Lending, and Private Debt Forum, Part 4, a two-day event. This is our fourth event in the series. Part 5 will be held on July 16th in New York City, conditions permitting. Today, we'd like to thank our sponsors, Nationwide, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off the Chain Capital, and Clarion Asset Management for making this event possible today. Also, thank you to all our Flyer members and the Flyer board for their support during these challenging times. For those of you who are not familiar with Flyer, Flyer is a 501c6 nonprofit organization that was started in 2007. The goal is to become the world's leading marketplace for alternative investments and alternative investment education. Since then, Flyer as an organization has helped thousands of firms in the capital raising process, aided in the allocation of billions of dollars to alternative investments, and we've leveraged technology to accelerate the due diligence process. Today, when you look at Flyer, Flyer has over 1,000 members with over $1 trillion in discretionary AUM. Thank you for attending the seminar today. Enjoy the day. Upcoming, our first presenter is Jesse Fahey, VP of Private Funds from Preqin. Jesse?
Great, thank you, Rain, and good morning, everyone. As mentioned, my name is Jesse Fahey. I serve as Vice President of Private Capital in the Americas for Preqin. Within that role, I'm in charge of data collection and quality, as well as thought leadership such as this. Throughout the presentation today, I encourage you to take advantage of Zoom using the Q&A feature at the bottom of your screen. I'll be monitoring your responses throughout the presentation and will do my best to answer them all at the end. For anyone who's not familiar, Preqin is the leading provider for alternative assets data globally. Across each asset class, we cover fundraising, performance, deal activity, and investor sentiment. Today, I'll be delivering an asset class update for private debt and private equity real estate, showing how the asset classes have fared this decade, as well as their performance through the onset of COVID-19. So first up, private debt. Tracking the growth of the private debt industry from just before the global financial crisis to today shows the explosive growth that has taken place over the past decade. In many ways, the GFC served as a launching point for the private debt industry as we know it, with regulations forcing banks to deleverage their balance sheets and alternative loan providers stepping in to fill the void. Fast forward 10 years, and the asset class has over $820 billion in AUM, looking poised to cross the $1 trillion in assets at some point in the next year, as the asset class has become a favorable choice for LPs planning for the end of the last bull cycle. That AUM sits with 1/3 waiting as dry powder, leaving private debt managers with a very healthy war chest with which to invest for any potential market dip. That part is notable since recession-era vintages tend to be where private debt funds can really outperform. In fact, the best performing vintages for North American private debt are 2000 and 2009. And private debt has a lot to offer their investors, beyond just diversification that all LPs tend to seek when they invest in alternative assets. In particular, investors expect high risk-adjusted returns to go along with a reliable income stream when they allocate to private debt managers. To the latter part of that, a reliable income stream is something that private debt has largely delivered on, with very steady returns throughout vintages this decade. The median IRR for most debt strategies has hovered right around the 10% IRR mark across vintages, give or take a couple percentage points depending on the year. Venture debt is the outlier here, with some years of tremendous outperformance, albeit at a much higher variance, breaking away from the traditional return profile for private debt. As a whole, private debt performed well through the last recession, recovering lost value by early 2010, much quicker than our benchmark for the wider private capital universe did. That helps deliver on the second reason why LPs target private debt for their portfolios, which is high risk-adjusted returns they believe it can deliver on. On the longer time scale, however, high absolute returns from private equity managed to outpace the overall steadier returns from private debt, highlighting the importance of proper diversification as the overall private capital index delivered better returns over this long time horizon. That has not slowed down investor appetite for private debt at all, as looking at the capital calls and distributions year over year highlights the rapid growth of the asset class. Unlike most private capital asset classes, net cash flow for LPs from their debt portfolio has been flat or negative for most of the past decade, with capital calls coming faster than debt managers can return capital. But rather than a lack of performance from these funds, private debt is instead a victim of its own fundraising success, scaling at such a rapid rate that managers are calling capital for new funds before they're able to exit and return capital to investors. That speaks to the great confidence that LPs have in the asset class, that they are willing to keep allocating large chunks of capital before their initial investments are realized. That certainly bears out when looking at fundraising performance, which was mostly non-existent prior to the GFC, but had great growth through the 2010s. Private debt managed to eclipse its pre-recession fundraising highs in 2015 en route to 5 consecutive years of $100 billion fundraising, spread out among a good mix of managers each year. That acceleration in fundraising had plateaued a bit, however, following the past 2 years after the 2017 peak, and that was before the outbreak of COVID-19. Despite private debt being a popular choice among managers in the late cycle, social distancing will likely prove too great a hurdle for many managers looking to raise capital this year. Larger managers with strong established relationships with existing LPs will be able to raise funds, while managers without that luxury will need to wait for restrictions to ease so they can begin to win the trust of more cautious LPs. But at least early on, private debt managers haven't been feeling the slowdown effects of the pandemic on their fundraising. In fact, through June, private debt fundraising has largely kept up with the averages from the last few years, albeit at an uneven pace. A very strong April has helped a lot, with more than $15 billion in capital closed. March and April represented the start of social distancing restrictions in the US, and a spike in fundraising was largely to be expected. LPs were willing to relax some due diligence as they realized their pipeline of investable funds was likely to pause and run dry over the coming months. Since that initial spike, however, May and June have been relatively quiet thus far, while managers and investors alike watch for updates in how the world tackles COVID-19. Overall, dry powder is at a healthy level, so even if fundraising weakens further, there are plenty of existing capital on hand to be invested. I've said already how the GFC signaled the launching point for private debt, but would be more accurate is to say the 2010s saw the rise of direct lending into the dominant strategy within the asset class. Direct lending was basically non-existent and now comprises nearly half of all AUM within the asset class. One area that's proportionally worse off than it was leading into the GFC is distressed debt, which has only $60 billion in dry powder despite all the cash that's flooded into the asset class over recent years. That could change quickly, however, as the popularity of the strategy during down years could make it one of the few strategies to see its fundraising improve as a result of COVID-19. On that note, private debt managers appear to be optimistic, with over 50 additional funds targeting an additional $53 billion in market today compared to what we were seeing at the start of the year. Almost across the board, private capital strategies have seen a slowdown in fundraising outlook, so debt managers bucking that trend and entering the market during the downturn is a nice show of optimism. And perhaps it makes sense that a lot of the funds newly entering market consist of distressed and special situations managers looking to take advantage of the changing market. Direct lending is still the largest strategy and has the most vehicles raising capital by far, but the changing market dynamic could lead to a diversification of capital across different debt strategies, as well as an increase in some of the more niche credit strategies beyond this chart. That optimism from distressed and special situations managers has some evidence to support them. Of the strategies that have managed to do any meaningful fundraising over the past 3 months, distressed and special sits funds lead the way, with just under $10 billion raised for each of them quarter to date. Fundraising has been okay with all things considered, but deal activity is an area where we are really starting to see the pandemic show up in the data. Deal activity has been pretty strong in recent years, eclipsing 1,000 deals 6 years in a row and $75 billion in debt size for the last 5 years. As you can see, 2020 is behind the pace from those years in both volume and aggregate debt size. The year started off relatively well, with strong aggregate values on the financing, although total volume lagged behind the monthly averages from the past 4 years. The last 3 months have really highlighted the decline in volume at a count of 50% less than the average in April, May, and the projection thus far for June. Aggregate debt size rebounded slightly in June, showing that there is still capital flowing, but similar to the fundraising market, it will likely be up to several large deals or funds to generate all the capital, as the volume simply won't be there. And that has been true across all industries as well, as volume suffers across the board with no real safe haven at the moment. So in summary, there's been a large effect from COVID-19, but plenty of bright spots within private debt as well. First, there's a very real chance that private debt could surpass the $1 trillion mark this year, a very significant milestone for such a young asset class. Further, within that AUM figure sits quite a large amount of dry powder. Private debt funds today hold more dry powder than all the AUM for private debt combined during the GFC. Returns have been solid and steady throughout the entirety of the past decade, performing exceptionally well during the GFC and delivering on that reliable income stream that LPs love and target the asset class for. Fundraising has been fairly resilient as well so far this year, with more funds entering market than ever before. In particular, distressed funds have been doing well, leading the way for fundraising the last couple of months and seeing a big increase in new fund launches through the pandemic. However, deal activity slowed greatly, and despite some large deals still taking place, volume is way down and doesn't show any signs of rebounding soon. Now we've gone through the credit markets, let's instead take a look at private equity real estate and how that asset class has been faring. Despite a terrible start with the Great Recession and mortgage crisis, the 2010s ended up being a great decade for private equity real estate, going from roughly $400 billion at the start of the decade to surpassing $1 trillion in AUM as of September of last year. Just as notable is the $387 billion of that, which sits in dry powder, 37% of total AUM, leaving private real estate managers in a great position for flexibility in the current market scenario. And given that the last recession was close to a worst case scenario for real estate, I'm sure that managers are eager to deploy their dry powder this time around. We've already gone over for private debt, so let's take a quick moment to see what LPs are expecting when they allocate to a private real estate fund manager. Of course, diversification is at the top of the list, but in addition to general diversification is a low correlation to the other alternative asset classes. Similar to private debt strategies, investors are also looking for a reliable income stream to go along with an inflation hedge in their portfolio, making real estate a great defensive investment for institutional investors. When we first look at how real estate has been performing, we'll start by examining the various risk-return profiles across different strategies, as well as their relative size by AUM. By that view alone, distressed managers seem to be clearly underallocated, delivering the second highest median IRR with the lowest overall standard deviation across the selected vintages. Size of the bubble in this graph represents relative AUM, so despite being an outlier due to the strategy's outperformance, these funds only represent $38 billion in AUM. Beyond distressed, however, we see a nice dispersion of returns for accepted risk, with a fairly linear progression of higher IRR against standard deviation of IRR, allowing LPs to pick and choose their investments based on their own risk appetite. Across almost every vintage year and strategy, real estate funds have delivered IRRs in the low to mid-teens, along with a few outstanding vintages of outperformance from value-added, opportunistic, and distressed fund strategies. Debt strategies have been lagging slightly, but what it hasn't given in raw IRR is made up for in consistency, right around 10% for each vintage size or each vintage since the GFC. And that consistency matters. Real estate debt strategies were the most insulated during the GFC, so investors in this strategy were able to recoup their losses first. That initial downside protection, coupled with solid returns and a very low standard deviation across funds in the benchmark, means that debt as a strategy has outperformed the rest of real estate on the recession timeline. And this is after a recession which decimated real estate returns, with the wider real estate benchmark not recovering until 2016. COVID-19 should be much less catastrophic for real estate investments, and while there are certainly concerns in certain segments and geographies, like top-tier cities, that will only open up opportunities for other managers. Looking instead by property type, we again see an impressive spread of median net IRRs, albeit with a larger spread of associated risk. The first thing that jumps out to me is that most managers don't like to be constrained to a single property type. As you can see, the diversified bubble is larger than all the specialist funds combined. Of managers who did align themselves with a specific property type, residential focused funds have performed the best over the selected vintages, with a median net IRR of just under 14%. Industrial and office properties also perform very well, clearing the 13% mark, while perhaps unsurprisingly, retail properties are left lagging behind the wider group. Investors seem to be happy with the performance across the asset class as well, based on how they've been investing capital recently. Fundraising has been incredibly strong, clearing $100 billion in capital raised each of the past 7 years, with 2019 being the best year yet with a record $168 billion raised. It took a while, but the asset class has been raising capital at pre-recession levels since 2015, along with a healthy number of funds closed each year. While 2019 brought us a record in capital raised, it was across nearly 100 fewer funds than the previous year, following a pattern of capital concentration and larger average fund sizes, something we've seen more acutely across the other areas of alternative assets. 2020 obviously will not keep the same fundraising momentum going. However, it is still on track to surpass the $100 million mark with a strong finish to the year. That strong run of fundraising years makes a lot of sense when looking at the influx of cash LPs have been receiving from their real estate investments. From 2013 onwards, LPs have been net cash flow positive every year, with distributions in excess of $200 billion between 2015 and 2018, peaking with a net capital of nearly $100 billion in 2016. Since then, distributions have lagged as capital calls have climbed higher, leading to net cash flows closer to zero in 2018. However, that was followed by a record fundraising year in 2019, so clearly LPs' attraction to real estate goes well beyond short-term cash flows. In addition to the lowering net cash flows, we've also seen our first contraction of funds in market in 8 years. The dip between January and today is relatively small, but still very notable, as the growth in number of funds in market has been incredibly strong since the asset class stabilized following the GFC. I use this as a barometer for fund manager optimism, so the lack of any new fund launches shows how difficult it is to bring in any investors during COVID-19. A recent poll Preqin conducted has the majority of respondents feeling that we would not see a normal fundraising environment until the first half of next year. So real estate managers considering a fund launch may be biding their time until then. Looking at the monthly breakdown of fundraising so far this year, it's hard to point to a clear area where COVID-19 is showing up in the data. Similar to private debt, there was a large spike in April fundraising, again assuming that many LPs decide to allocate to managers that they had already been speaking with, assuming that their potential pipeline of investable funds would not increase the further into the pandemic we went. June figures are low, perhaps a sign that existing fund pipelines are finally beginning to exhaust for LPs. Looking at the strategy of funds that have closed during the pandemic, there's been a clear preference for opportunistic fund strategies, capturing the majority of capital raised in both April and June. One strategy that's conspicuously absent is distressed real estate. This might be an issue of timing. PPP and other government stimulus through the pandemic has been propping up many tenants and businesses that otherwise would be suffering right now. This keeps asset prices artificially high, so distressed funds aren't quite able to take advantage of the scenario yet. As stimulus programs begin to expire, prices should better reflect the economic reality, and distressed funds might start to become more commonplace. With that said, there's still plenty of dry powder to be invested across different real estate strategies. Chief among those are opportunistic funds, which currently hold $128 billion in dry powder, more than any other private real estate strategy. During the GFC, opportunistic strategies also saw the greatest amounts of fundraising within the asset class, so that large pool of dry powder could see itself increase as the year continues. Distressed funds represent the smallest pool of capital, so an uptick in fundraising there would likely be necessary if a large amount of distressed opportunities begin to open up. The private real estate deal market has been red hot coming into the year, with almost 10,000 deals in both 2018 and 2019 to go along with 3 consecutive years of aggregate deal values in excess of $450 billion. Though we are only in June, the drop-off compared to the past 3 years has been stark, and all deal-making momentum has clearly been halted by COVID-19. Looking at a breakdown of deal volume by property type, office and residential unsurprisingly lead the way, comprising just over half of all deals taking place each year this decade. Residential remains a large portion of the deals taking place each year, but the progression from the start of the decade to now has seen it become de-emphasized, from around 30% in the early decade to just 23% last year, and taking a backseat to office properties for most deal volume. Perhaps the most notable property type by its growth and significance has been for industrial properties, going from a relatively small slice of total volume to 16% of total volume last year. Comparing this year month over month to the past 4 years shows how far activity has dropped off, both by volume and aggregate deal value. Month over month deal activity has plummeted, with May seeing just half the volume and a third of the value that we had during the same months between 2016 and 2019. June still has a week to go, but the drop-off is even more stark, with the real estate industry fully feeling the social distancing effects. Highlighting 2020 and looking at volume by month really shows the huge effect COVID-19 has had on deal making. After a relatively strong start to the year, volume has fallen every subsequent month, with the 289 deals recorded in May being the lowest total for a month since 2013. Though only halfway through the month, June is on pace to be even quieter, with only 113 deals recorded so far, compared with 1,100 in June of last year. We had conducted a survey in April asking what industries and strategies investors were targeting and avoiding across all alternative asset classes as a result of COVID-19. The number one response for what investors were avoiding was retail-focused real estate, with 34% of all respondents highlighting that as a strategy to avoid. Piling on retail is something of a theme this decade, but deal volume so far this year supports it, and I don't foresee it changing anytime soon. As for what investors were targeting, logistics and data centers were highlighted as attractive property types, which tracks in deal volume so far this year, as industrial property types have been somewhat resilient, at least in comparison to the other asset types. So in summary, real estate has crossed the $1 trillion in AUM and has become the third alternative asset class to reach that milestone. It also has the best overall dry powder ratio since the GFC, leaving managers in a great position to take advantage of any drop in asset prices as a result of COVID-19. By both strategy and property type, there's a nice spread of risk-return profiles for LPs to invest in, allowing them to achieve the highly diversified portfolios they seek. Despite the current scenario, 2019 was a banner year for private real estate, with a record level of fundraising, as well as near records for deal volume and value on the year. 2020, however, has seen that deal volume evaporate, with June down as much as 80 to 90% of where it was at the same point last year. The silver lining in there is that industrial property types have been somewhat resilient to the pandemic after showing tremendous growth over the course of the 2010s. Within those, logistics and data centers have been listed by investors as the property types that they're specifically targeting within their real estate investments. Thank you everyone for listening. I hope you enjoyed the presentation. If you'd like a copy of the deck used today, you can reach me at the email on the screen now, and I'd be happy to provide you with a link where you can download it from. And with that, I think we'll move on to the Q&A. I'm sorry, Michael, I know I went a bit long. Can you let me know how much time I have left for questions? All right, I guess we'll just start answering them, and you could cut me off whenever we are fully out of time. So Laura Bevel, first question up, could you briefly review how you capture this information? Yeah, absolutely. So Preqin, we've been in business since '03. Essentially how we capture all of this is a mixture of web scraping technologies. So any public sources coming from government regulatory filings, news sources, and firm websites. We've mapped all this out, and we have technology that captures the data and updates on our platform. And then in addition with that, we have a team of over 200 analysts who work as relationship managers, speaking with managers, GPs and LPs on a daily basis, speaking with them and working with them to update their profile with proprietary info. So it's really a two-pronged approach, which gives us best-in-class data. So thank you for the question there. Everyone asking if they can receive a copy of the presentation. Like I said, I believe a copy will be made available on Flya, and also you can send me an email here. I'd be happy to send it over to you afterwards. Mike Khalil, any data on performance of private credit funds which originate their own loans compared to loans bid on or traded in the secondary market? So we do track secondaries data and performance as part of our alternatives package. I don't have that data on hand right now, but if you'd like to speak after, certainly something I might be able to help you out with. A lot of questions was asking about the deck. Again, that'll be made available to you. Just reach out to myself or Flya. And Laura, do we send out regular surveys? We do. In terms of individual surveys on someone's fund or LPs, we also send out market surveys basically on a monthly to quarterly basis, just checking the temperature, and all that data is aggregated, put onto our platform, and also used in presentations such as this. Okay, I think one more question here.
One more, Jesse.
So specific to distressed mortgage funds, do you have any sense of where various product delinquencies might fall? Brad, yeah, that's a really tough question. I think one issue, which I mentioned before, that's kind of muddying this, is how much regulatory support will everyone get? Right now in most states, it's impossible to evict anybody. There's a lot of programs in place to help prop up people who are falling behind on mortgages or rent payments. So I think we really need to let some of these stimulus programs expire and see how the numbers start panning out before making any predictions along that line. And I think we are now fully out of time. Thank you again, everyone, for asking questions and listening. And again, please send me an email if you have any follow-up. Thank you.